Good evening, TheoTrade. This is Corey Rosenblumen. You're watching the Theo Nightly video for the 7th of April, 2020. We are looking at the sectors. We're looking at the sell-off, and let's categorize this all within this sell-off swing from the highs down to the lows and back again. So we're looking at these 9 sector ETFs. We do this by the sector rotation model with the 3 bull or risk-on type of sectors: financials, technology, and discretionary at the top. The mid-cycle sectors, which are industrials, materials, they're in the middle there. And then energy, which has to do a little bit with crude oil. Note the sell-off, and the gap in all the movements between there is off to its own island. Now we also focus on these 3 defensive names or risk-off names. Those are XLP for staples, V for healthcare. That's been in the news, right? And utilities, which tend to serve like the bond market, at least in terms of stocks or sectors, and that's XOU. What we're looking to do is from the peaks, or from these really a year view, where are they? So we can see these numbers that financials are down 20%, technology's off about 9%, and 13% for consumer discretionary, so on and so forth. These mid-cycle sectors are off, quite a bit, 20% each. Let me skip energy for a moment. And XLP, which is a defensive type of name, keep in mind that when the stock market falls or we go into a recession or negative headlines hit for an extended period of time, these 3 sectors should do the best they have. And that's where we are. So staples is down, as of a year ago, roughly about 1.5%. Might not seem like that after we did the peak to drop off here, but from about a year ago, or a year ago to this day, 52 weeks ago, the strongest are these 3. And they're about what they traded 1 year ago. Everything else is beneath that. So healthcare is only off 1.5%. It's actually the strongest, and that's in air quotes, of course. And utilities down about 4%. So that's where we start. If you go peak to trough, we can certainly do that a different way in how we calculate the percentages, but we may look at those differently. But still, the recoveries are in all of these sector ETFs. Oh yeah, I made an exception for energy. The exception for energy is down 53%. So that is the hardest hit, and that again is on the backs of crude oil or other energy type of products. Remember, these are all stocks. This is not anything with commodities. This is a stock-based, really a stock-based putting together a conglomerate of these products. So XLE would be energy type of names, and K is technology, which is tied to the Nasdaq, but certainly not identically the Nasdaq. That's where we are. Energy is the weakest, staples the strongest, and then everything else falls somewhere in between. That's the bigger picture. Let's now take a look at the S&P, which is again down roughly 10 or so percent if you count today's close. We were down even further than that, but have come back. So again, this is just a year-to-year comparison. Take the high to low, that is 3,400 to 2,200. That's a bear market. That's 20%. I don't really think in those terms necessarily because, right, terminology, that's all, out there. So what we do for our positions, our trades, where are we now? Gravity to gravity in the S&P futures. These are Don's levels. There's a lot of them on the chart, as you can see. And if you zoom in even closer, that's what the hourly chart does for us on the right side. You can see how the market is played from gravity to gravity. That's important to note in the S&P at least. Now, all that being said, we'll pull the grid back. We had a stellar reversal day in today's market, which is up into Don's 2731 gravity, all the way down to 2682, which is also Don's gravity, all the way back in everything else in between. So this is where the power of the gravity spots come in for us on the intraday trading levels. However, bigger pictures are in play. Let's focus on those. Now we'll talk about the daily chart. And again, this is a sell swing and recovery, snap back, rally, or bounce. I would say watch what happens now into 2700 and the 2800 S&P level. Same would be true in the Nasdaq. That has pushed into or above the 50-day moving average, and right there is a 200 simple. That is going to be the pivot for NASDAQ traders, roughly 82.50. That is, again, your 200-day simple moving average. And you can see how that plays out. The market gets above it, yanks back to it like a magnet. That's a snapback trade as well. We talked about the 20-day EMA smackdown. The 200-day simple moving average smackdown is even bigger. You don't see that happen that much. You get above it, snap right back into it, and you can always go long into the rising 200-day simple moving average. Of course, I prefer the shorter term averages, but when you break under, it tends to extend. So anyway, here we are back in the 200-day simple moving average that we will be watching extremely closely on the strongest of the equity markets futures, which is the Nasdaq. Quick update in crude. This is an extent why XLE Energy is down where it is, and you're having the 20-day EMA smackdown in play for crude oil. And that is a departure swing from the 27 print, and we're playing that out in the intraday frames. Gold is a little bit different because it made a new high above 1,700 per ounce, kept that uptrend going, but then got faded. It itself was smacked down into the top of the resistance boundary, and that is just shy of 1,700. If you're trading gold or GLD, that will be your critical bull bear pivot. And for GLD, it's going to be 158, roughly speaking, per share, 157. You might structure trades on a departure from there. And one more note about bonds. TLT Treasuries, which takes into account the ETF of the longer term dated treasuries. IEF would be the shorter term dated treasuries. And we'll talk TLT. It has pushed away from 270, which is a key pivot for the intraday and short-term traders. 170 for TLT. That is holding support. We'll be watching 164 extremely closely in this week. Should stocks take another sell swing, you may see bonds push up back to 170 or beyond. And of course, if stocks really start to recover, if the good news comes back in and the stimulus and everything else boost the equity market higher, at that point you'll see bonds, or TLT at least, crack and break under 163 and 162.50, which opens up a sell swing. So those are the levels to watch if you're trading TLT. The same would of course be true in ZN, which is into the 20-day EMA. Remember the little pullback or the snapback or the smackdown? It happens in reverse. Something gets a little overheated, overcooked, or over bullish, it'll get a rubber band play all the way back to that 20 and then back above. So that's what we'll be watching in the bond market going forward. As always, please be careful. Please watch your risk. In-out spreads are going to be key. The spreads are still wide. The bid-ask spread still wider than normal. Volatility is higher than normal. And even with this VIX at 46, that's still elevated, way, 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 way elevated than normal times, which is roughly between 12 and 20. So keep this in mind as you make decisions, as we watch what the Fed has to say tomorrow, as we start to get earnings coming up soon, and of course this holiday shortened trading week. As always, be careful and be safe. This is Corey Rosenblum with your TheoTrade nightly video for April 7th, 2020.